India stands at a crossroads. On one side, a historic trade deal with the United States, promising lower tariffs and stronger economic ties. On the other, the cost of switching from cheap Russian oil to American energy could hit India's economy in the billions. The question is simple: what will India pay, and who ultimately benefits? After months of negotiations, Indian Prime Minister Narendra Modi and US President Donald Trump sealed a landmark trade agreement. Tariffs on Indian exports to the United States are now reduced from 25% to 18%. But Trump tied this concession to a condition: India must cut back on Russian oil imports and increase purchases of US energy. The numbers are stark. Russian oil has been heavily discounted under sanctions, trading between $50 and $55 per barrel, sometimes even lower at $35. American crude, by contrast, follows the Brent index, hovering around $62 to $65 per barrel, with additional shipping and insurance costs. This means India would pay an extra $7 to $12 per barrel, potentially adding $9 to $12 billion annually to the import bill. In rupee terms, that's rupees 600 to rupees 1200 per barrel. And when you import millions of barrels, it's tens of thousands of crores of rupees, impacting fuel prices, inflation, and government subsidies. Moscow has aggressively offered discounted oil to retain customers despite Western sanctions. From less than 1% of India's imports in financial year 2020, Russian oil now accounts for over 35 to 40%. The discount advantage has been a key factor in keeping India's fuel bills manageable. American oil is high quality and strategically aligned with US markets. But for India, it is more expensive due to longer shipping routes, benchmark prices, and minimal discounting flexibility. Switching suppliers is not just an economic decision, it is a geopolitical one. Rising fuel costs ripple across the economy. Agriculture faces higher fertilizer, irrigation, and transport expenses. Pharma companies, which dominate exports of generics to the US, could see profit margin drop by 5 to 10%. Even small tariff reductions in the trade deal may be offset by ballooning energy bills, leaving consumers and businesses to bear the brunt. India must now weigh the gains from lower US tariffs against the billions of dollars extra for energy imports. A shift from the Russian oil could raise India's fuel import bill by $9 to $12 billion. And this may also push global prices higher by 10%. It's a delicate balancing act: trade benefits versus energy costs, economic growth versus geopolitical alignment. The India-US trade deal promises a new era in commerce, but the cost of reducing dependence on Russian oil is real, measurable, and could reshape India's economy. The choice made now will not just affect fuel prices, they will influence agriculture, healthcare, exports, and inflation for years to come. The question remains: can India navigate this trade energy tightrope without breaking its economy? With Rajashish Kanjalal, Bureau Report, India Today Global.